Hey everybody, welcome to your weekend review for the week of Monday, November 21st, 2022. And oh, what a week it was, albeit a short week. UMBS 5.5, we're down 3 basis points on the open on Monday. It's a very short holiday week, so you have to expect low volume and volatility. Illiquidity in the market makes it easier for fewer traders to have a greater impact and small trades to move the market around. Plus, everyone is kind of resting for the following weeks when we get CPI, PCE, and then the December Fed meeting on back-to-back weeks. The December 2022 Fed Fund futures are now see a 85% chance of a 50 basis point hike and a 15% chance of 75 basis points. If we hike 50 basis points, then the Fed Funds target rate will be between 4.25 and 4.5. The December 2023 Fed Funds futures rate have a wide range of possibilities. However, the central tendency is that the final Fed Funds rate will be between 4.25 and 4.5. So the consensus is that we will get a half in December and then a couple more quarters and then bring it back down by the end of next year. Throughout the week, we're going to have a couple of things. We have a 2-year and 5-year note auction today on Monday. Then we have jobless claims on Wednesday and also get consumer sentiment and sentiment of inflation on Wednesday. That stuff is coming in early due to the holiday. Sometimes it's tough to find good news out there, and independent mortgage bankers and subsidiaries have some bad news to report. The MBA reports that the production costs exceed $11,000 per loan in the third quarter, leading to a net loss of $624 per loan originated. The average pre-tax production loss is 20 basis points in the third quarter, down from an average net production loss of 5 basis points in the second quarter. This is down from 89 basis points a year ago. Mortgage servicing continues to be the silver lining in the current rate environment. With prepayments and delinquencies low, mortgage servicing has made up the difference for a lot of companies. At the end of the day, we ended up being down 16 basis points all in all. Again, we are floating around this 100.534 mystical pivot point. Can't quite decide if it's going to be a floor or if it's going to be a ceiling. If you thought that a national rail strike had been averted when the Biden administration announced that a deal with unions was made in September, think again. One of the largest rail unions, representing 28,000 conductors, has narrowly rejected the deal. While 7 of the 12 unions have approved it, the rejection still means a strike is possible as soon as December 5th. If this happens, there's a potential $2 billion hit to the U.S. economy and could ruin the fund for a lot of retailers and home builders and travelers. On Tuesday morning, bonds were flat in Asia, then slightly stronger in European hours. U.S. equity futures and European stocks rose as investors parsed comments from Federal Reserve officials on clues of what's going to happen, plus some news out of China that they're getting a lot of COVID lockdowns and COVID infections. Volume and volatility are both high in the bigger picture of things. MBS points on the open. Treasuries were down 3 basis points to 3.795. Fed officials have been broadly maintaining the steadfast stance that they have to fight against inflation. Yet San Francisco Fed President Mary Daly also noted that they need to be mindful that there is a lag from the policy changes to what we see in the market, while her Cleveland counterpart, Loretta Meester, who should really start shutting up a lot more, said she's open to slowing the tempo on rate hikes. Despite increasing interest rates, consumers turn to credit card spending to support the stronger than expected 1.3% increase in retail sales in October. Resilient consumer spending has shifted the Atlanta Fed's GDP now forecast in the fourth quarter from an initial estimate of plus 3.2 to plus 4.2. But the market is forecasting a recession in the second half of next year still, so it's going to slow down. But this is all happening, as I've been saying for a while, because of credit card debt. Credit card debt is up 15% year over year, the largest jump since the 2001 recession. Basically, with the increase in rates have gone up on credit cards about 2.75% recently, but we've gotten just enough wage increase to handle that minimum monthly payment. Also, the savings rate has dropped 3%. It's now the lowest since the 2008-2009 recession. Odds are looking higher and higher of a rail strike at December 5th. That will not help things in the supply chain. At the end of the day, we are up 31 basis points on the day, ending up at 100.56, which puts us right above that pivot point at 100.534. We have some real strong lines here. That 100.534 is proving to be a strong indicator. We have a strong ceiling at the 100-day moving average and a strong floor at the 50-day moving average. Mortgage bonds are now closest to the cheapest they've been since the financial crisis by some measures. Money managers like Pacific Investment Management Company, otherwise known as PIMCO, or the people that shut down First Guarantee, are betting they've fallen enough to make money on these things now. Investors like Double Line Capital, Vanguard Group, Morgan Stanley, as well as TCW Group have all piled back into debt from U.S.-backed entities like Fannie Mae and Freddie Mac. They're drawn by an unusual shift in bonds. Mortgage-backed securities usually get hit particularly hard by unexpected changes in interest rates because nobody knows exactly when these bonds and when these loans are going to pay off. Now it's kind of feeling like there is a sense of what's going to happen from the Fed. So money is going back into mortgage-backed securities, and hopefully that spread between treasury yield and mortgage yield, 5.5, 3.75, will narrow up a bit. That's how we can get some gains in the market or gains in the mortgage rates without having an actual gain in the market. We also got a post from our sponsor at www.wellthatmakessense.com. And this is from that great book, Persuasion, Back Roads to Attention, Managing the Background and Inviting Favorable Evaluation. So it's how you can manage the environment around your clients when you're selling them to get a more favorable outcome. For example, they did a study in the book where just playing German music in wine stores increased the sales of German wines, even though the people that bought the wines didn't notice hearing the music or don't speak German. So definitely check it out at www.wellthatmakessense.com. Which brings us into Wednesday, November 23rd, which is a Friday on a Wednesday for most of us. Some of the best Fridays are on Wednesdays. Bonds closed in Asia, further adding to the thin trading conditions of Thanksgiving week. Yields briefly dipped below unchanged at the start of the European session, then drifted higher. A hair higher in the domestic session. UMBS were up 11 basis points early. China confirmed its first deaths from COVID-19 in the last 6 months. Probably been a lot more, but it's the first time they're actually admitting it, so it must be bad. They're also announcing new restrictions in the capital of Beijing and locking down the southern city of Jiangsu. China reported just over 26,000 cases on Monday, nearing its April peak, and it shut down many parks, businesses, and hard-hit districts. So that's not looking good for people trying to get items, appliances, and things for the supply chain, as well as toys coming in for Christmas. Durable goods came in up 1.0 versus a 0.4 estimate. It was 0.3 previously. Core durable goods came in at plus 0.7, which was supposed to be flat according to the forecast. It was down 0.8 the previous month. Last month was revised down by 0.4. Initial jobless claims came in at 240 versus a 225 estimate as 223 before. Yield curve continues to invert with the 2 to 10 spread now at 80 basis points. So the 2-year rate is actually 80 basis points higher than the 10-year rate. It's a sort of inversion is last seen in the early 1980s, which was one of the worst recessions on record. Consumer sentiment declined in November. The University of Michigan reported sentiment is weighed down by rising interest rates, a weakened labor market, and continued inflation. They said inflation expectations next year ticked down to 4.9% from 5%, which is still very high. And longer term expectations are at 2.9 to 3.1. Last time expectations were this high was 2008, and I think we all remember how crappy things were then. New home sales rose 7.5% in October, which is a 632,000 annualized rate. There is a negative revision to last month, which is making this seem better. Markets expected a 5.5% decline, so even an artificial 7.5 is a pretty big win. In total, sales are down 5.5% year over year, but it's 5.5% down from a historically great time, and the median sales price rose 8%, although I'm sure that builders are going to find some way to have their sentiment down over this because they're a bunch of babies. Initial jobless claims came in at 17,000 higher than the previous week. Like we said, it came up at 240,000. It's a kind of a dual-edged sword. We need this to help inflation, but it sucks for our neighbors and our brothers and sisters that are losing their jobs. Continuing claims rose 48,000 to 1.55 million. We also got the Fed minutes, which showed that most members support slowing the pace of increases. So there's still going to be increases, but smaller ones. Saw considerable uncertainty on the rate peak, so they have different opinions on how high it has to go. Several recognize that there are still lagging effects of past hikes, so basically the data we're seeing now does not reflect the last 2 hikes, and they want to see all the data. At the end of the day, at the end of the week, we ended up being up 41 basis points to bring us at 100.97, which is pushing us much closer to that 100-day moving average, which will be a pretty strong ceiling. We'll see how that goes. We have a floor, I probably call that a floor now at 100.534, and we'll have to see if that holds all of next week. Interesting stat here that came in. If you ever wonder how banks make their money, a web search shows that the 1-year CD national average is currently 0.43%. The current 1-year risk-free treasury bill is yielding 4.75%. So you can get around that spread and you can see where the bank earns 4.75 a year and pays you less than 0.5%. That's a pretty good rate of return. So they borrow money from the public at 0.43, invested at 4.75, and head to the golf course. With mortgage rates dipping this week by 24 basis points to 6.9%, the largest decline since July of 2022. Home prices trending down since the peak in June. First-time mortgage applications spiked a pleasant 4.4% week over week. Still, they remain down 39% year over year. As for refinancing, because rates are high, activity fell another 1.6% week over week and is now down 86% year over year. Looking into next week, we do have some big data coming. Case-Shiller about home prices will be interesting. That'll kind of factor in. This is also generally the week where we get the updated FHFA conforming loan amount limits. So we'll see what those come in at probably this week. We also get ADP jobs on Wednesday, as well as the GDP preliminary number. So we'll see how the economy is doing. We also get core PCE inflation, which is a Fed favorite. We get ISM PMI on Thursday. And then Friday, we get non-farm payrolls and the unemployment rate. So it should be a volatile week next week. Kind of give some insight in what to expect out of the Fed and predictions into the next year. So I hope everybody has a great Thanksgiving. I hope you have fun, be safe, and spend time with your families. And if you got a little bit extra time and want to learn some stuff, check out our common sources and influences, particularly our sponsor at WellThatMakesSense.com. Thank you and take care.